in 1914, so up to 1914 there was this Victorian monetary theories which were used to guide central banks. But in 1940, and real bills doctrine was the mainstream view, but there were opposed people who were arguing. In fact, Thornton was an early Keynesian, and he argued that the real bills is wrong and that you can print money. He was basically took a position of Keynes that in a recession you should use expansionary monetary policy. You can issue money without any backing. So after, in 1914, it was clear that the real bills doctrine is not correct. You need more money than can be backed by assets in order to create full employment. So over the period 1914 to 1944, between the two wars, there was massive confusion in both philosophy and practice. The central banks were all trying to go back to the gold standard because there was this concept that the gold standard had brought us a huge amount of prosperity, and so the way to get back is to go back to this. But now, as we have studied, the same policies which worked very well in the pre-war period failed to work in the interwar period. And we have gone through this in detail. So from the global depression in 29 to the Nixon-Shock in 71 is an era in which basically in 1929 you had this great crisis. This crisis was caused by basically banking sector expansions. From 1914 to 1918, the World War lasted one, and basically then after that there was a period of prosperity in the USA, because the USA had survived without any damage to the economy, and so there was a great boom in demand for their products by Europe, which was completely devastated by the war. And in addition, there was this plan, Marshall Plan, exactly, which was said that basically we will provide money to Europe to help them to rebuild. So huge amounts of money went into Europe, creating a deficit financing boom, and this printing of money also created huge amount of demand for American products, which created a boom in the American economy. And so there you had what was called the Roaring Twenties, where the economy was doing very well. And as we have studied from Minsky, that there was huge amounts of credit creation because the economy was in a boom, so the property values rose and the real estate prices rose, and so there was a lot of stock market rose, and so there was lots of people who were ordinary people started investing in stocks by being encouraged. They would take loans to invest because they could make a lot of money. So then there was this collapse, and we have now studied why booms collapse. That's a very important part of the analysis by Minsky. That basically the loans that are taken are transformed from hedge loans to speculative loans to Ponzi loans. It sort of happens automatically without and so once you get into a Ponzi loan, then that's unstable and that can collapse, and once one collapse happens, then that has a effect of multiplying, because people are borrowing, and then people are this loan, the IOU, is being used as a collateral for credit creation. So now once one loan collapses, then a lot of money that was created with the backing of this loan, that also collapses, and then that causes further ripple effects. That's why you have this. The bursting occurs very suddenly. So after this bubble burst in the banking crisis, then you had in 1933 the massive regulations came into place, and there was this Glass-Steagall, Federal Deposit Insurance, the Fannie Mae Corporation. This was actually a very important innovation, which basically private banks are not equipped to make 30-year loans. That's such a long period risk that the private banks cannot afford it. So in order to make this possible, the government created an organization which provided guarantees on mortgages. So the banks could make mortgages, and as long as they satisfied certain rules, they would get covered by this Fannie Mae, which would insure them against the possibility of loss. So once this was established, then this allowed the creation of a large amount of credit for the purchase of homes, and this was a major contributor to prosperity, because people can finance homes over a period of 30 years in installments, and so lots of 30-year loans were given. Banks were restricted to be local. No bank could operate across states. There was an interest rate ceiling to make sure there is no competition among the banks to offer more and more interest. Banking became the most boring profession on the planet. There was the 3-6-3 rule: borrow at 3%, lend at 6%, and on the golf course at 3 p.m. Nothing to do. So the boring system is also a very safe system. There were no crises, no efforts by central banks to control crises. There's this periodization table which shows the crisis frequency. So in the 1945 to 1971 period, you have 0 banking crises. This is the post-World War II to the Nixon-Shock. 71 is exactly Nixon-Shock. There were currency crises, exchange rate crises. That happens for different reasons. Twin crisis is when you have both a banking crisis and a currency crisis. So basically the key thing is that then there's 73 to 97. 97 is the East Asian crisis, and then okay. So during this period of time, 44 to 71, there was this issue of the central bank, what it is supposed to do, and the Treasury, what they are supposed to do. So basically, through trial and error and experiment and experience, these were the general rules that were adopted in most places, although there were individual variations from country to country. So the Treasury was in charge of monetary policy, and the central bank was in charge of foreign exchange and implementation of banking regulations and liquidity management, making sure that the government has enough money to spend, and handling the debt of the government. And the Treasury established monetary policy. It also established the budget, so how much the debt is going to be. The bank managed the payment of the debt. And fiscal policy, of course, that also needed to be financed, but that was not the central bank role. And of course, creations of rules and regulations regarding banks, these were jobs of the Treasury. Implementation of these rules was the central bank job. So, Nixon-Shock occurred in 1971. Again, the same dynamic. the war, Vietnam War, needed to be financed, and so I think that I have omitted something, which is, just one more slide here. Basically, in this period, from 44 to 71, we have Bretton Woods. In 1944, it became clear to everybody that gold standard cannot be restored. So they met and they said, okay, what's going to be the post-war? It was World War II was winding down, and it was going to end soon. And so people said that, okay, after the war we're going to have a trading system. So what's it's going to be? It cannot be the gold anymore. So at that point, they said that let us. Actually, Keynes had come in with a very nice plan for international trade, but that plan was not accepted because it didn't give any favor to the powerful countries. And the alternate plan that was put into effect was that, okay, some countries have gold, principally the USA, and so we will use, instead of the gold standard, what was called the gold exchange standard. So we will use currencies which can be exchanged for gold. So the countries like USA and some other so-called hard currencies promised to redeem their currencies for gold, but under strict conditions. First of all, one of the things was that it was not freely, and first of all, in the USA, they banned the public from using gold or even from converting to gold. And they even banned private parties could not go to the central bank and ask for gold. But the intergovernmental transactions could be done in gold. Basically, that was the thing, that if a country, the central bank of some country says that I have a lot of pound sterling and I want gold for that, so then the government, on a government-to-government basis, the UK would supply gold. So all the other people, they would use pounds or dollars, or and so these are the countries that could be exchanged for gold, and these could be held as reserve currencies. So instead of gold, the especially the poorer countries of the world, they used the currencies of the hard currencies, and mainly they would use the hard currencies of their principal trading partners. So in the British colonial era, actually, the pound was king, but in the interwar period, the dollar took over as the central currency, and so all over the world, basically the dollar started being used as the reserve currency. But the idea was that dollar is just a symbol of the gold that is behind it. So this gave an enormous power to USA in the sense of it would be able to print dollars, and when it prints dollars, it's basically printing gold. So in the Bretton Woods also, there was an agreement that the governments would be responsible for not printing over many dollars. But basically in the Vietnam War, the USA had an enormous amount of budget deficit, and they printed lots of dollars, and then General de Gaulle threatened to cash some of these dollars, and so to prevent that, Nixon announced that dollar would no longer be converted for gold, and suddenly we were in the free-floating era. Currencies are not tied to anything. No, so in this period, then, monetarism of Friedman was tried, and basically it failed. The basic theory of monetarism is that the money supply in the economy is a multiple of the reserves. This was actually introduced by Friedman. Friedman restated the basically monetarism had been discredited by Keynes, and Keynes was the dominant philosopher. His economic theory was the dominant philosophy. Keynes himself had a very radical philosophy in economics, which was suppressed in favor of the new classical synthesis. But even in the new classical synthesis, money has a short-term impact on the economy, but in the long run, money is neutral. And that was all based on quantity theory, that the level of prices in the economy is a multiple of is just proportional to the money supply, and money is proportional or a multiplier of the reserves. So basically that means that the central bank controls the reserves. So this is called a theory of exogenous money. As opposed to this, there is endogenous money, which means that money is created by the private sector according to the demands of the economy, so you don't have any control over money. So the Friedman rule was that since money is the multiple of reserves, if you just keep the reserves growing at a fixed amount, this should be, first of all, you need to make sure that money grows at least at the rate of growth of the economy. Technically, if the economy is growing at 3% and you grow the money supply at 3%, then you have zero inflation and you have exactly enough money for the needs of the economy. So that would be perfect. But because of price rigidities, some prices cannot go down. So if you allow inflation to happen, then what will happen is that the real price will automatically go down even though the nominal price is fixed. And so that will allow the economy to equilibrate. So a certain low amount of inflation is good for the economy. So Friedman said that keep reserves going at 6%, the economy will go at 3%, and the inflation will be 3% also. And this will create a fixed and known rate of inflation. This was based on what we have already discussed, a misunderstanding of Keynes that unemployment is caused by money illusion. So this fixed growth rule will create price stability, financial stability, and growth by ensuring full employment because of lack of money illusion. So this was the idea of the Friedman rule. So Volcker announced that I'm going to follow this rule for the moment, and this failed because it created the greatest depression. It did bring down the inflation rate, but it also caused a huge amount of depression. Volcker kept thinking that this is a short-run phenomena and it will wipe out, but it did not. Also, Volcker could not control the money supply. He tried to control the reserves, but the ratio between the reserves and the actual money was very erratic, and that is because credit creation by banks is not regulated by the central bank, and when the economy is booming, they create lots of money, and when it's going into free fall, they contract the money supply. So after the Friedman rule failed, there was a search for new ways to conduct monetary policy. Obviously, the Friedman method does not work. By the way, Friedman gave an interview in 2000 something, and he was asked, what did we learn from the so-called monetarist experiments in the US and UK in the start of Volcker was in 1979 he came in, and basically in early 80s we had monetarist experiments everywhere which failed, and sort of so what did Friedman say in response to this? So Friedman said that the monetarist experiment was in 79 when Volcker announced that he was going to take the quantity of money and not the interest rate as his guide, but he didn't do it. If you look at the monetary aggregates, they were more variable during the Volcker period than any other previous time in history. So he did not follow the monetarist course. So according to him, because the money supply was not growing constantly at 6%, So Volcker did not follow Friedman's rule, and so if you look at 1980 to 95, you say that the aggregate monetary growth has come down, and with it has come inflation. So basically he says that inflation is purely monetary, and that's proven by the data. So this is a very very perverse way of looking at what happened actually. But what the reason to say this is that this is one reason why textbooks continue to teach this failed theory of the multiplier. I was going to give you the 2014 reference here, but again I failed to do that. The Bank of England has published, finally admitted that this is the multiplier is wrong. So even though what I am saying that the monetarist experiment was a spectacular failure, this is not. This was something that was known to all central banks. They understood that things don't happen this way. But this knowledge did not make it from the experience and policy to the textbooks for some reason. It was misunderstood and misinterpreted. So the idea that the world has confirmed the inflation is monetary is actually exactly the opposite of what has happened in that period, because over that period all the monetary equations failed, and there was a huge amount of discussion as to why this relationship, the money demand which was stable up until the 70s, has become unstable. And finally, because nobody could get a money demand equation to fit, this was quietly dropped. And as I said, Richard Werner has an alternative theory called the quantity theory of credit, which says that basically if you take this credit creation by banks into account, then you can make the quantity equation work. And that fits in with the story that we've been saying, that the reserves by themselves are not enough. Reserves are used to do credit creation, and credit creation is a very important part of the story. And if you take that into account, then you can make the quantity equation work. Also, you have to take into account the prices of stocks and the prices of land. This is omitted from the standard. The consumer price level does not include the stock prices and does not include land prices usually. So, so that's why the inflation index doesn't capture all of the places where the money is going, and the money quantity does not capture all of the places where the money is being created. So once you take both of those into account, then you can get back into the quantity equation fit, which is not available otherwise.